you've broken through now. So I think, when I look at fundamentally what's going to happen, what I think is going to happen over the next year or two, I think liquidity is going to expand greatly. And I think that will be the next impetus for the gold price to move higher. I think it just takes time for sentiment to shift. So, if I'm not totally opposed to technical analysis, but that previous chart you showed, I mean, you can wait till that thing kind of breaks higher and confirms the gold price.
Hello and welcome to Capital Cosm, everybody. Today we have a special returning guest that I am super stoked and excited to have back on the show. It is Mr. John Polomny. John, thank you for coming on.
Again, happy to be here. Yeah, thank you.
Yeah. Before we get started, though, nothing in this video constitutes financial advice. Neither John nor I are a financial advisor, so please do your own research. With that said, John, let's go ahead and dive right into the nitty gritty. Gold, what is going on with gold? Popped over 2140 just last night, and now it's back down. Last time I checked was at 2040. So you've had these wild swings of $100 or more within the span of less than 24 hours. So what's your prognosis on gold?
Well, I mean, as people that know me have said, or I've heard me say before, that I always have a position in gold, physical gold, as I'm not going to get into the reasons why people that follow me know, but or we can delve into it. But I think if you look at a chart of gold over the last, I don't know, several months, 6 months, it's tried to come up and break through the $2,000 level like 3 or 4 times. And so it finally broke through. I think if you look at a longer term chart, some people that are chartists would say that it has this super bullish cup and handle formation, and then it finally broke through. What happened in the last day or two to make it go through, who knows? I mean, quite frankly, what I think is happening and what I've written about before in my newsletter and into my free email subscriber list, been talking about this for a while. Gold basically is a monetary instrument it's a currency. It competes against other currencies. So if you look at gold, the gold price and several other currencies like Japanese yen, the euro, what have you, it's already made all-time highs. The dollar recently weakened, and that's probably the impetus to push it through 2000. And I would also suggest that one of the main corollaries or things that intermarkets effects towards gold is real interest rates. And so real interest rates had been positive up until recently, and they have now shifted towards moving in towards the negative direction. And in the past, if you go and look at the past, the gold price is primarily, in my view, at least in the U.S., is mostly driven by the direction of real interest rates. So that's the interest rate minus the inflation rate. So rates have come off recently, and so real interest rates are moving from about 2% to more towards zero. I mean, just at the change here, inflection. So I think that's going to, I think what you're seeing is being it as a currency, it's kind of sniffing out. Don't forget this: Bitcoin's over 40,000 now. And Bitcoin is a pure liquidity-driven instrument. And so these things are starting to sniff out, I think, what's going to happen. Remember, these markets are always forward-looking. So they're probably starting to sniff out what's already happening around the rest of the world, which is the shift from tightening to easing, which I've been tracking. The majority of central banks now around the world are actually cutting rates or instead of raising rates. And so I think the new liquidity upcycle, which will take place over the next couple of years, I think these instruments are starting to sniff that out. So yeah, I think I think that's probably the main impetus. Like I said, I think the dollar dropping recently, that's you got to look at these things from intermarket, right? So why would the dollar drop? Because rates have dropped. That doesn't attract as much capital into the US dollar. The dollar drops off a little bit, gold punches through. So I think gold's going a lot higher over this decade. We can talk about why that is. I'm not going to sit here and make wild prognostications about $10,000 gold or anything, but just because of the fact that I think that liquidity is going to be expanding greatly, let's say, that gold will be a beneficiary of that.
Right. So you mentioned Bitcoin being over 41,000 as a kind of like a signal towards more and more liquidity. Do you think that you're saying the market's already kind of pricing quantitative easing in at the moment? Kind of.
Well, yeah, it's already happening. Like if you look at, I follow basically about 160, 170 central banks around the world. And over 3 months ago, you had a market shift towards the majority of central bank actions being cutting rates, vice raising rates. And so you're starting to see a bottoming in global liquidity, which have been contracting for a year and a half because of inflation. And you've seen a lot of the banks, central banks,
Brazil. I think you mentioned Brazil before.
Brazil,
yeah.
Mexico, Colombia, Chile, they were on the forefront. And so they've been cutting rates. Of course, the big central banks like the US, the EU, Canada, Japan, I mean, they're kind of like in this pause frame, but you can see what's happening. We're seeing, you're in recession in Europe. The United States, in my view, is heading towards recession. And so you're in a pause phase at the big central banks, but they'll inevitably begin cutting. So I think you're in this, people can, like I said, these markets are forward looking and they start sniffing this stuff out in advance. Now, I know people probably come in the comments and say, no, Bitcoin's going up because of the halving and all that's coming up. I don't get into all that. It's a pure liquidity instrument. It's sniffing out the more liquidity that's going to be happening. And people front run these things, right? They position early, people that are in the know. And so these things, like I said, these things are going to respond to what's going to happen in the future, not what's happening yesterday or today. So I think that's a lot of it. And, you can add to that. You got to remember, my thing is, in the short, medium term, liquidity and sentiment is what drives markets. And so when liquidity is shifting, sentiment's still probably negative in some of these markets around gold. Everybody hates gold. Look at the price of the gold miners. You're at all-time highs in the gold price, and the gold miners are like, they're not moving at all. So either they're still totally ignored, or that's telling you that maybe the gold price is not going to be sustainable. I suggest that what you're probably going to see is the gold miners play catch up over time. So I think basically, if you're looking to buy something that's undervalued, that's what you would probably want to be looking. That's what I've been telling my subscribers, and we've just been kind of waiting for. I've been kind of waiting for the typical end of the year tax loss selling. But I've been scaling into some gold miners recently. I think there's some opportunity there.
Yeah. I just want to pull this up really quick on the screen. This is the GDX. Let me know if you can see it. This is the GDX versus the gold price. So this kind of tells you how GDX performs relative to gold. And I mean, you can see it here. I mean, we are pretty much resting on the support line. I know you don't care much for TA, but this is a pretty descriptive visual of what you were just alluding to. I mean, the GDX, the gold miners index, is historically cheap when priced in the actual metal itself.
That's right. And it's just been totally it's not really on anybody's radar screen. So I think, I like to look at things that are undervalued or ignored. And I think this is a perfect example right here. I mean, you have gold prices, like I said, at all-time highs, and this thing's like flatlined basically. So, it's either telling you one of two things. This is going to play catch up, or the gold price is going to come in substantially. I don't think the gold price is going to come in substantially going forward. So
yeah, because essentially what you want this thing to do is that you would expect, if there was a bullish setup on gold, you'd expect more speculative money to come in on, onto the more speculative names, i.e. the gold miners, right? Because there's always going to be that added confidence to go further out on the risk curve and get more leverage. But the fact that you're not seeing it yet on the GDX or GDXJ, to your point there, kind of alludes to the fact that this may not be a breakout, but it could be a fake out, more likely. There's
Yeah.
no certainties, there's just probabilities. But that's what you're kind of saying there, right?
Well, I mean, yeah, I mean, that's what I was thinking. You've broken through now. So I think, when I look at fundamentally what's going to happen, what I think is going to happen over the next year or two, I think liquidity is going to expand greatly. And I think that will be the next impetus for the gold price to move higher. I think it just takes time for sentiment to shift. So, if I'm not totally opposed to technical analysis, but that previous chart you showed, I mean, you can wait till that thing kind of breaks higher and confirms the gold price. Typically, it's reverse what happens. The gold miners will move first, and then the gold price will move. But the markets are so wacky now, and gold is just the gold mining industry and the sentiment towards it is just really, really bad unless it's really specialized down in with the advent of the cryptocurrencies and stuff. I just think that maybe it's believe me, if the gold price moves higher, 2,500, 2,700, something like that, the gold miners will move. It's just a matter of time. So, but I don't think there's any reason to run into them right now. Wait for a confirmation, and then, you could then maybe scale in. But I'm pretty confident that I think that we're probably going to see over the next 18 months to 2 years a pretty substantial uh, move in the gold price higher, and then a subsequent rise in the gold mining stocks. So I think there's some opportunity there. It's totally unloved. Nobody even talks about gold stocks. So uh, I would sell my Magnificent Seven stocks and buy gold stocks. That would be a smart thing to do, I think.
Yeah, yeah. I was just asking myself the other day, um, what what's probably the hardest thing for me to buy at the moment? And that's probably in most like I came up with gold stocks, gold mining stocks, GDX or whatever. And that's probably a sign that that's probably what you should buy, because you should always, there's this old adage of, you should, what you should buy is what makes you most uncomfortable, and vice versa.
Exactly. And like
So
I said, sentiment's so low in it right now that I think that's where the real opportunity is. Of course, you have to size it properly for the risk. I mean, but typically what you would see is in past bull markets, the gold stocks usually do 3 to 5 times what the gold price does, depending on which gold stock. So if you get a 30% move in gold, you have 100% move in gold stocks typically. So I think there's definitely opportunity there.
yeah, yeah. Let's go ahead and segue over to oil. Oil has been dragging its feet now for several weeks, despite geopolitical conflicts in the Middle East between Gaza and Israel, just tensions all around, the Red Sea and so forth. What is going on with oil? Is it, you have all of these risks surrounding the oil price, but oil can't catch a break. Is it? Do you think it's something from the demand side? Is demand? Are we in a recession right now when it's impacting the oil price through the demand funnel, or is there simply more supply that than there's being let on, or maybe a mixture of both?
Well, I think it's all of the above. I mean, you definitely have slowing economic growth around the world in major economic blocks. I think that goes without saying. You got to remember, oil is priced at the margin, so it doesn't take if there's a million barrels of demand, the millionth and one barrel prices the rest of the barrels. So if you have a slight oversupply or undersupply, you can get fairly big moves. The other thing is that you have some seasonality. There's just so many factors that go into it in the short term to try to call the oil market where the price is. I mean, I think it should be illustrative that the Saudis and OPEC Plus have been cutting production, and yet the oil price continues to move lower. So that's not good. That's not a good indication. I think when we were on before, I said that, I have a base case that, I was wrong last year. I thought we would already be in the U.S. in a recession. I think we had some certain sectors in a recession, but I think as we move into 2024, the recession will become more clear for folks. And like I said, energy's priced, oil in particular is priced at the margin. So you've had things like, um, not one thing is causing this, but several things conspiring. Like we basically don't have any. We basically look the other way on Iran. Iran's pumping again. We made cut a deal with Venezuela. Yeah, in any one of these things individually is not going to. So you have extra supply in the market, and then you have demand is still making highs, but people were assuming we were going to have a deficit of 1 million to 1.5 million barrels a day. And it doesn't look like that's happened just because of maybe some slowing demand and increased supply that was not anticipated. So like I said, in the short term, who knows what's going to happen? I think you're going to be in a range, it could be anywhere from, 65 to 90 or something like that. But, I think that where I'm focused at is in the oil field services, particularly offshore, and a sweet spot of anywhere in that range is perfect for those companies. And there's many companies now that have got the memo uh, that they'll do well in that kind of range because they've paid down their debt. And so I think if you're interested in messing around with oil companies, I mean the time to buy them really for the big move was during the pandemic, but I still think there's some opportunity here and there, but I like mostly oil field services offshore because it's just obvious that there's not enough capacity and rates of moving higher. But I mean, it's kind of a mug's game. I've kind of given up trying to forecast the oil market in the short term. I do think that the lack of investment that we've had, of reinvestment into new reserves and production is eventually going to impact the market. We'll have higher oil prices longer term. I mean, that's kind of a cop out, but I don't think there's anybody that I've seen that's been able to consistently predict where oil prices are going to be a month, 3 months, or 6 months from now. There's just too many moving pieces. And but I do say that I think there's quite a bit of information that would lead one to believe that the lack of investment is going to lead to supply issues down the road. So I think there's some opportunity here and there, but I would just be caution that if you're trying to forecast the oil price, that's kind of a mug's game, in the short to medium term.
Yeah, and I totally agree. I think where you can kind of get your edge, however, is by going long in a time horizon that most people aren't willing to go long on. So 2 to 5 years, etc. People are trying to identify what forecast the oil price within a near term, time horizon. But if you simply look at this thing, 5 years down the line, and you ask yourself the question, is oil more likely to be higher or lower in 5 years' time? And I think that's where you can make the best bet in the sense that you'll have more of an edge compared to the rest of the crowd. And I want to highlight the oil services companies that you just alluded to. This is the oil services ETF. And so despite, oil going from in negative territory to $75, the oil services companies are still well off their highs in 08. So, I mean, they've been moving slowly, but consistently. And, to your point there, these things, if you look at their financials, I mean, they're essentially, all of the bad oil services companies were pretty much wiped out in the last 10 years. So it's kind of like a Darwinian approach where you only think you've got left are these, clean balance sheet, very well managed oil service companies. And as a whole, they're still way down, historically. So
Yeah, I mean, that's a very instructive chart. That just That's how I think you have to look at it. That's where your real advantage is. If you're going to sit there, or if you're just a dividend type investor, it depends what you're trying to do also, right? I mean, if I was putting together something for the next 20 years, and I'd be looking at maybe one of these really long-term royalty companies or something like that and start doing some cash flow analysis on that. Or if I cared about dividends, well, you can put together a pretty good dividend portfolio, but if you're looking for capital gains, which is what I'm looking for, then I think you're, like you said, the risk reward and the is in oil field services, particularly offshore. It's just so atrophied the industry, and there's been like billions and billions of dollars of investment that hasn't happened that needs to happen. And I kind of looked at it last week in one of the videos I made. I mean, the reserve life index of the major oil companies is the lowest it's been in about 20 years. So they have to invest. They're going to invest. I mean, to really kill this capital cycle that's happening, you would have to see like oil down at like $40 a barrel and have it stay there for like a year and a half before people would start cutting back on some. Exxon's not going to stop developing offshore Guyana. Well, maybe if Venezuela invades, I'm not going to get into that, but you know what I mean? I mean, Total's not going to stop developing the Venus discovery because oil's at $50 or $60 a barrel. These are 5 to 7 year investments, 10-year investments for them. So once they commit to it, that's they're going to spend the money. So I think that's where, and I would stay away from onshore oil field services. I would focus on the offshore. That's really what's atrophied the most, and where you have such small capacity. And like you said, all the excess and marginal producers were pushed out. So you have just a very small industry that's going to be receiving a great amount of capital over the next 10 years. So that's exactly what that chart that you showed is showing. But most people don't have a 3 to 5 year time frame or a decade. They're looking at weeks or a month maybe. So that's a different deal. That's like, you might as well just go to play red and black on a roulette wheel. I have no advantage in trying to determine, like you said, what the oil price is going to be in a month or 3. Who knows? It's impossible to know.
Yeah, and it's actually a really good advantage to have, because if you look at the average holding period, and I brought this up many times before on the show before, but if you look at the average holding period of the average investor, 50 years ago, you were looking at about 5 years for an individual stock. Today, 6 months.
Yeah,
or somewhere around that ballpark. So that's how, that's one way you can have an edge compared to the rest of your peers, is by simply having patience.
no, that's right. Agreed, 100%.
One thing I also want to point out with just the oil industry as a whole is that all of the easy stuff has been pulled out. And so, you're left with, you still have these deposits, or not, you still have these, deposits, but they're a lot harder to pull out, and they're more energy intensive to pull out. So some people don't like the EROI, your energy return on energy investment metric. But if you do look at that metric, it has gone down significantly. So, and it's important to kind of juxtapose that with the idea of rising interest rates, increasing the debt burden. We all like to point out the 80s, where we had like 15% interest rate, something along those lines. But the important distinguisher between then and now is that the EROI of oil was a lot higher. So, you can increase your debt burden, but then you're also able to extract more productivity through oil, because oil is energy, and energy is pretty much GDP. There's a tight correlation between GDP and energy usage. So, back then, sure, you can raise the interest rate all the way up to 15%, but then you also had a lot of cheap oil to pull out and leverage productivity and get tax dollars out of, through the added productivity of the society. Today, you're increasing your interest rates, you're increasing your debt burdens, but then you can't you can't subsidize it by easily increasing your productivity from a societal point of view, not just from an EROI point of view, but like everything, everything else. The morale of the society, the country's gone down to the point, there's an ethos, an anti-work ethic ethos and so forth. So it's not really the same one-to-one comparison between then and now with what Volcker did and what Powell was doing. Volcker had more luxury to do what he did, whereas Powell, he doesn't have, much room to stand on because of, decreased productivity.
Well, not only that, I mean, when you want to talk about the energy markets, it's the most politicized industry. So you have, at least in the Western countries, although I think it's starting to come apart now, you had a view that, people were trying to constrain or limit the amount of exploitation of, oil and gas, and to the point where people won't fund it. I mean, you just had the big conference in Dubai, and but what you see is that like I was just looking at before we got on here. I mean, Chevron and Exxon backed out of the methane thing. I mean, the whole thing's coming apart. So they're going to try to hold it together. But regardless, like you said, higher rates, well, that increases the hurdle rate for any type of project you're trying to do. If you're an oil company, where are you going to get finance from? I guarantee you cannot build another coal mine in the United States or in the West, in the OECD countries. And so the demand for these things is always going to be there because they enable civilization and they do enable the GDP to grow. And you have all these people around the world outside of the OECD that are normal thinking, that want to develop, and they're going to want energy. So my thesis has always been, it doesn't really matter what happens in the West. It only matters what's happening in the global South and East, because that's where the developing world is. And if you don't want to burn diesel or coal in the US or Europe or Canada or wherever, they'll burn it in China, India, Bangladesh. I can go down the list. Okay. So that's all that will happen. And I anticipate that happening. I think over time, at least until the political zeitgeist changes, which I believe it's starting to, people in the West will get poorer, and people in the global South and East will take those molecules and increase their standards of living. So in the end, these are extractive industries. You have to reinvest. We have not been reinvesting. So I always tell people this: if you look back 10 years from now, you're going to see, when you talk about resources or energy, you're going to see the chart go from the lower left to the upper right. You're going to be in a secular bull market over the 10 or 15, 20 years. But there will be times when cyclically inside that secular move, there will be price, you'll get bear markets inside of a long-term bull market. That goes without saying, just like you'll see a cyclical bear market in the context of a bull market, or vice versa. So a cyclical bull market and a long bear market. So this is what I think people forget. They just think it's one and done. Oh, well, you said like you were bullish on coal, but coal prices went down. Yeah, because there's an economic cycle you have to take into context too, but inside the context of a 20-year time frame. So if you have a global, I wouldn't say we're in a global synchronized recession, but when you have a lot of economies underperforming, the demand for energy won't be as high. And so these things are priced at the margin. So you could have periods of a year, 18 months where the prices stagnate or actually go down. But that doesn't mean, you're not in a longer term bull market. The thesis is still in place. So I think one of the things I try to encourage folks to do if they're going to be involved in this is you really have to understand the cyclical nature of these different markets and understand how investment works, time frames of investment, how capital is attracted because of excess returns. I mean, mining's a horrible business. Extracting minerals from the earth is a choo-choo train, horrible, net destroyer of capital over the long term. It sucks. These are commodity businesses. However, there are short periods of time where, because of underinvestment, excess profits can be gained, and you have to understand that concept. I mean, if somebody just buys oil companies and holds them for 10 years, well, you're not going to have the same return as someone that understands the cyclicality and is able to move in and out of these things based on the cycles. That's something that a lot of people don't understand. These are, especially when you're playing around with juniors. I mean, forget about it. These things are burning matches. That's even worse, right? So you really have to understand the relationship between the cyclicality of a particular industry or resource, the sediment that's current in that particular resource sector or whatever theme, and then what the liquidity situation is, because that's what drives a lot of this. It's not just well, you said that uranium was going to go up, but I haven't made any money. Yeah, well, you just bought it last month. Were you buying it? No. When myself and Malcolm Rawlinson had a discussion about this 4 years ago, when one of my first YouTube things, you could buy a lot of these things for pennies. That's when the real money's made. That doesn't mean there's still not juice in the lemon, but it's not like the outsized profits are not going to be the same.
Yeah.
So that's what I think a lot of people make mistakes in these cyclical resource type situations. I mean, Rick Rule talks about this all the time. Guys like him, and it's not hard to understand, but it seems like people forget this, and they're buying. That's why I hate to say this, I use the analogy. I'll say it's like, people chasing the shiny object, that whatever is hot that week. Like you started off the conversation about gold because gold made a new 52-week high, but a lot of us have been talking about gold for a year now, that it was, what we was making new highs in different currencies. Central bank buying had been at all-time highs, lack of investment, all these things. And so now it's all conspiring to see a breakout. And of course, everybody's going to be making videos. I'm not saying it's a bad thing, but I'm saying the interest level goes up. And you can see this like on Google Trends. I use that a lot to check sentiment. If I want to see like what sentiment is, like put in there gold stocks or the gold price, and you can see the interest in the Google searches, how it spikes. It's interesting to see how
guys.
the psychology works.
I mean, what John is saying is pretty true for us YouTubers. I mean, we're going to report to you whatever's hot and trending, just FYI. So let's go ahead and segue over to uranium. You brought up COP28. Uranium, nuclear power are, big topics on the agenda, or were at COP28. Uranium's at what, $81 now? It's been trending higher and higher for the last, I want to say, since March. It's been consistently moving up. What's your take on uranium?